Risks, fees, and expenses. Read and consider it carefully before investing.
Welcome back to Squawk Box. Let's talk about the broader markets now. Here with us for that is Lindsay Bell, investment strategist at CFRA Research, and Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management. Good to have you here.
Thanks for having us.
Ray Dalio, LinkedIn post, he's worried about the markets. Front page story of the Journal, rally in the metals markets and commodities. They seem to be sending conflicting messages, right? To me, you see a rally in commodities and you think, actually, that's portending good things for the economy. But he's nervous. Where do you fall on this issue?
I think that there's good reason to be optimistic right now on the economy and on the markets. And I think the rally in commodities is telling you something. It's telling you that Asia in particular is doing reasonably well, and that's drawing demand. Global growth is still on the upswing, not on the downswing. And I think that plus a slightly weaker dollar is enough to continue drawing U.S. companies to do pretty well.
Lindsay?
I would say we are long-term optimistic on the market, but I will say we're in August, going into September, the two most volatile and worst performing months for the S&P 500. So I can see where some of the concerns come from. We have some pretty big issues that are coming to the forefront here. We've got budget talks, debt ceiling, tax reform that's going to be on the table. It could create a lot of volatility.
His LinkedIn post is about geopolitics, which thus far haven't derailed the market at all, but he seems to suggest that a moment is coming. But that's not your concern. You sound like it's the classic, God, it's been a really long time since we've had a correction, and reversion to the mean would suggest that at some point it's going to happen.
Yes, exactly. That's where we're at. Geopolitics are always something that's really hard to anticipate anyway. The fundamentals are there, though. Like some of the major things, like when we enter bear markets, you usually see an inversion of the yield curve. We're nowhere near that right now. We have a lot of positive economic data points.
You know the copper roof thing, right?
Yeah.
Every bull market has a copper roof. That's what I think you were alluding to, right? Which is not, doesn't really make sense, because if things are really percolating, as far as global growth goes, it should be good for the market, but it seems to indicate maybe you're getting towards the end of a cycle or something if every bull market has a copper roof.
Well,
but that might be something. But it doesn't seem like like there's inflation that's going to result from commodity rises, because you don't have it in the wage sector.
Well, the wage sector is interesting because although the reported wage numbers are, 2.5% or something, that doesn't include a lot of things like bonuses, commissions, and so on. It only includes salary and wages. If you look at tax data from payroll taxes, you find actually more like 6% wage growth or 6% total compensation growth. At the high end of the job market, there's a shortage. There is labor price inflation. It's at the lower end that we're not seeing it. I don't think the Fed's particularly noticing that. Contrary to Lindsay, I do think an inverted yield curve is a concern. The spread between the 5- and the 30-year treasuries is fairly tight. That gives them very little room to raise rates more than maybe the ones that they've promised for the rest of the year, in which markets are kind of doubting anyway.
You're suggesting we could get an inverted yield curve. It's closer than...
It's closer than people think. I think we're probably about 2 hikes away from that, and I think that the Fed is and ought to be very concerned about that. That's why they want longer rates to rise as well, and the way to do that is to get stronger economic growth.
What about just selling all the stuff you own on the long end?
Well, they're not selling. That's the thing. What they're doing is they're letting maturities roll off. What's the maturity? What's the duration of a 30-year bond that's maturing? It's 0. It's still an ultra-short instrument. So unless they actually sell long-term instruments, which they're not doing, you're not going to have a benefit to the long-term interest rate.
So, Lindsay, you said long-term optimistic, but you seem to suggest short-term you thought the market might struggle a little bit. In terms of a strategist, that's what you are. You tell your clients to do what?
Well, I think right now that it makes sense to get a little more defensive, at least in the near term. And you're seeing the utilities rally. We like that sector.
Even though it's really expensive.
I know, it's really expensive, but that and even consumer staples, the earnings have really been good coming out of that group, even though you have a lot of competitive pressures and lack of inflation. So, near term, we're a little more cautious, would definitely consider defensive sector.
One note, because I feel like the headline on this Ray Dalio piece is getting misinterpreted. If you really read into what he's saying, he's actually the opposite of where you are, which is to say you may be short-term bearish, long-term bullish. I would contend, if you really read into what he's saying, and I'm going to read you a moment of it. He says, while I see no important economic risks on the horizon, meaning like immediately, he's not worried about now. He's saying, I'm concerned about growing internal and external conflict leading to impaired government efficiency, inabilities to pass legislation, set policies, and other conflicts. Then goes on to say that he thinks it looks like it could be 1937 in the future. But I think he's sort of and by the way, he's been making this argument.
We are now economically and socially divided and burdened in ways that are broadly analogous to 1937.
I think it's analogous to 2008.
But just to put a fine point on it.
Don't you?
We can go back.
Ineffective government, gridlock, divided.
I did an interview with him on this show.
Okay then.
I want to say 5 years ago, where he's made this argument before. So the only reason I suggest that is this is not somehow, I wouldn't even say this is his fresh take. He's been making a version of this argument. Maybe he's getting more pessimistic long term.
It was a construct so we could have a different version of the market discussion.
But there's nothing new about ineffective government and gridlock. That's where we've been. That's I mean, it's less so probably.
Just making the point that he may be close to where you are.
The waterboard stopped. The waterboarding stopped.
Well, I think tax reform is going to be a really great test for Congress, and the gridlock that we are seeing, because it is impairing, will eventually impair economic growth longer term. And if we don't get some sort of tax reform or tax
What do you
cuts,
think is built into the market right now on that?
there's very little built into the market on that.
Zero.
Right now.
So it doesn't go down.
Zero.
Yeah.
So it does not go down if nothing happens this year.
Right.
As a
And
result.
you probably get a strong rally if they do even anything.
Even a 5% cut.
Yeah.
I think they'd get a rally.
Thank you, ladies and gentlemen.
Dalio was bearish really bearish, like 5 years ago, wasn't he? Do you
Like
remember?
I said, it was a construct for our market
By the way,
discussion.
I wasn't worried about the content. I just wanted to make sure everybody
But
understood.
recently, I just remember
he's been on this tack for a while.
I just remember thinking, oh boy, he's got he's got a gazillion dollars under management, and he's really bearish, and it never came. At least at this point, we're still waiting for.
He's talking bearish, but he's still fully invested.
Right. A lot of people are like that. All right. Coming up, we're going to talk about the role of business leaders.